Welcome to this webinar today. Lovely to see you all. I think we'd like to make this session as interactive as possible, so please feel free to use the chat if you have any questions. I think my colleague's going to put a few housekeeping rules in the chat. But lovely to see you. We can have the next slide. Actually, I think we'll introduce everybody. So my name is Paul Fisher. I'm an associate fellow at the Business School. And I run the Oxford Programme on Negotiation, and I also do a lot of work on strategic influence. And I'm going to hand over almost immediately to my colleague Andrew, who is an expert in real estate. And essentially in this session, we'll look at strategic influence through the prism of real estate, but also the wider finance sector as well. And I'm going to draw a few of the findings from Andrew's thoughts and research and see how it can apply to all of you. So I'm going to hand over. We also have colleagues from Oxford who are happy to take any questions you might have in terms of some of our programs. We have Clara and we have Christine, who I don't think you can see Christine's face there, but lovely to see you all. I'm going to hand straight over to Andrew.
Hello, everybody. Thank you very much indeed for joining. This has been an interesting experience for me. I've learned a lot from preparing this seminar. You know, you think when you get to a certain age that you know a lot, but actually I've learned a lot through doing this. And what I've been thinking about is the real estate investment process. And I've been thinking a little bit about selling my own house and thinking about how strategic influence works in the house market. So if we go to the next slide, I'll just introduce the topic as I see it. So what is it about real estate that makes negotiation interesting? I think there are some particularly interesting aspects of it. It's the size of it, the importance of it, the slow-moving nature of prices, and so on. And so why is strategic influence important, and what is strategic influence? I'm keen to learn from Paul. What different negotiation strategies might we use when we're buying or selling a house? And then we'll have time for a Q&A at the end. We're also going to do a poll about what you think the right approach might be to selling a particular house that we're going to have a look at. So next slide, please, again. So, you know, here's a house. It's probably somewhere in London or maybe Oxford, a semi-detached Edwardian villa. How would you maximize the price of your house if you were selling that property? If you were thinking about marketing as a general topic, the obvious answer would be, well, we should maximize our market exposure, maximize the number of eyeballs that see this property, and thereby maximize the effective demand for it. If we maximize demand, then we're going to get a higher price. It's obvious, you know, economics, fundamental economics says that, you know, supply and demand drive price. There's only one of these houses, so the supply is pretty limited. So what we need to do is maximize demand, which means maximize eyeballs, maximize market exposure. On the other hand, I know from experience, and I hear people talking about this all the time, particularly in the commercial property market, that you don't want to overexpose your property to the market. In fact, there's something called off-market transactions, which the majority of the commercial property world thinks is somehow superior. So we have this curious idea that selling a property off market, meaning without exposing it to the maximum number of eyeballs, could actually maximize the price. And this is very surprising. Why would that happen? You start to think also about this concept of stigmatization, the idea that if your property is publicly exposed to the market and is on the market for quite a long time, so that lots of people have seen it, not just once, but a few times, then the market starts to think there's something wrong with the house. It's a lemon. So it's stigmatized. And stigmatization of a real estate asset is a terrible thing. It might mean that the property becomes extremely illiquid for a long period of time, or that you achieve a lower price for it. So then the strategy, the selling strategy might be to limit the number of people that see this property. So you might decide not to put a board outside the house, for example. You avoid overexposure and you focus on a small number of qualified buyers. So you go to a small number of people, or you ask your estate agent to go to a small number of people who appear to be looking for this sort of house without widely advertising the property. So when would you When would you maximize market exposure and when would you not? When would you avoid overexposure? Next slide, please. Now I've got two difficult slides. This is the first one. The second one will be coming up in a couple of slides time, but this is the first one with a bit of technical information in it. The first thing we need to be aware of with real estate is that there are significant direct trading costs. So if I sell a house, it's going to cost me something for the estate agent, something for maybe a survey. I might actually do stuff to the house before I sell it to get it ready for sale. So there's a whole series of costs that are involved. At the moment, I'm going through a decluttering process just to make the house look better and more presentable. If I'm buying a property, there are significant costs. You know, in the UK, we have a property tax called stamp duty. Around the world, there are transaction costs. They have lawyers' fees. We're going to have legal fees on both sides. Now, in the UK, let's say, because of stamp duty, primarily this transaction tax, it's going to cost me something like 6% of the property's value or price to transact it. So if I were to buy it and sell it, it's going to cost me something like 6 or 7% of the property price. That means that if I buy a house for £1 million, I need to get back 1.06 or 1.07 million pounds just to break even. Now, this is a significant point. I've got to make an apparent gain in order to break even. So what happens then when the market isn't rising in price? You know, when there is no pressure to increase prices, what do I do? I might sell the property and lose money. I might do that, but human beings hate to do that. If I've borrowed a lot of money, then I'm even less likely to want to sell it and crystallize a loss because the percentage of my equity that I would lose if I sold for less would be even bigger than if I hadn't got a mortgage debt. So what happens when we've got this problem of a weak market and we've got heavy trading costs is that the rational thing for me to do is to delay selling my house until prices recover. So if I delay selling my house, the amount of houses available in the market will fall in weak times, and we notice that liquidity disappears. So that there just isn't a lot of trading activity. And estate agents start complaining like hell because they're not making any money at all. There's just no transactions in the market. Now, in addition to the direct costs of trading, there are also huge indirect costs. And I'm sure any of you who've bought a house, sold a house, will know what these indirect costs are. There's a huge amount of time and effort involved as a seller in, first of all, preparing the property for sale, showing people around the house, deciding whether you trust somebody or not. Lots of indirect effort. And if you're a buyer, it's just the same. It might be even worse. You've got to drag yourself around the market looking at many, many houses until you find one you like. When you find one you like, you've got to negotiate with your partner about whether it's the one you're going to bid on, how much are you going to bid, do you get the bid accepted, do you have to go for sealed tender, what relationship do you need to build with the broker, and so on and so on and so on. So lots of time and lots of effort. And with that, given that it's going to take me maybe 2 to 3 months at minimum to actually close the deal, then there are other risks as well. The risk that something goes wrong. Now imagine that I'm a buyer of a house and I manage to do a deal with the seller, but then it takes 3 months, 4 months to complete the transaction. And during that 3 to 4 months, there's an absolute boom in the stock market and a boom in house prices. Obviously, there's a risk that the seller says, sorry, I'm going to put the house back on the market and ask for more money. What happens if if interest rates rise, we enter into some sort of difficult situation, as we've been in the UK at least twice in the last 4 years? Well, maybe I will buy it. Maybe the buyer will pull out. Maybe the buyer will say, I'm going to take my time here. I'm overpaying for this property. So there's a risk, and quite apart from all the time and effort, there's a big risk of abortive expenditure. So I don't want to risk any of this stuff. And it takes a long, long time to sell a house. Old research says that something like 298 days, over 9 months, is the average transaction time for a property from starting to think about selling it to actually getting the money into the bank. I'm sure that number's come down a little bit, but not a lot. Next one, please. Now that's in sort of in normal times we have a relationship between weakness of market and illiquidity, the amount of time it takes to sell a house, and we've got these risks and these delays. But when we have shocks laden on top of this, then we've got even more triggers for delays. And the fact is that there are shocks in the real estate market every 2 to 3 years. We've had interest rate shocks. We've had dot-com booms and busts. We've had the global financial crisis. We've had COVID. We've had, in the UK, we had Brexit. And then we've all suffered from interest rate rises in 2023. Now, if we just look at the interest rate rise as a particular issue, the most recent issue that we've dealt with, go on to the next slide, please. This sets up the challenge that we've got right now. So interest rates rise. Question, what does that mean for house prices? Well, the man in the street, woman in the street would probably say, well, it's probably not good, but we don't really know how bad. It's not good because people borrowing money on mortgages will be paying higher interest rates. So that must mean they're going to be less likely to pay a full price. They're going to think about it. As a professional investor, I know there's a relationship between interest rates and prices, a formal relationship. It will take me a bit of a while to work through the algebra, but I'll form a view about it. But frankly, we don't really know. It's unquantifiable variables which are affecting the price. Things like changes in the risk premium, changes in expected inflation rates and inflation hedging, and so on and so on. So what happens in practice is that we don't really know how bad the shock is. So we don't want to reduce the price of the house by too much. So asking prices fall very slowly. And because asking prices fall slowly, and they're probably still too high, liquidity disappears. Nobody wants to buy because nobody really knows what the value of the house is. It takes the market at least 2 to 3 years to work out what's going on. And we're just about at the point now in 2025 where we've worked out what the fair price of a property is in the new interest rate environment. It's taken that long. Now, finally, when you have a shock like interest rates, it puts people sometimes into financial distress. And here's a question: do you want your buyer to know that your mortgage debt has just risen, and actually your mortgage debt is now more than the asking price of the house, that you're a desperately distressed seller? Do you want people to know that? Probably not. So again, this idea about lots of eyeballs, lots of transparency in the market doesn't work. You don't really want a lot of transparency. You need to be able to hide behind some sort of marketing approach. And that's part of your negotiation strategy, of course, is not letting people know that you're in some sort of distress. Next slide, please. Now, this is my other difficult slide, for which I apologize, but this is a great piece of academic work by somebody who used to be a colleague of mine at Side Business School. And what it's showing is, if you look in the middle of the graph where there's that spike, that is where house prices have risen by nothing, zero. And as you go to the right, this is situations where house prices have risen by 10, 20, 30, 40%. As you go to the left, this is where house prices have fallen by 10, 20, 30, 40%. And the heavy black dots are the amount of transactions that you get in these situations. So how many transactions do you get in the housing market when the price has fallen by 20% since I bought it? And the answer is not very many, 0.5% of the total stock. What happens if prices have risen by 20%? Well, how much trading do I get? Well, 4 times as much, 2% of the entire stock. So this is great research which illustrates what I think I intuitively understood, and that is that if prices fall, there's not going to be a lot of trading in the property market. People need prices to rise in order to transact, and this is a great piece of research which illustrates that. Next slide, please. So here's my last slide, and I just want you to think about this. Here's a house. You're thinking of selling it. What would the appropriate approach be to marketing and selling this house? Would you want to expose it very widely to the market, have lots and lots of people look at it, put a board outside the house, make sure it's in the local internet site, Rightmove in the UK, property.com in Australia. Would you want your estate agent to have a picture in his shop window? Would you want all of this stuff? Or would you want to limit the amount of people who are aware about this house? Can you just think about that, and we'll be running a poll about how you think about this. And at that point, once we've done that, I'll be handing over happily to Paul to learn a little bit more about that. So does it make a lot of sense to market the property? Yes means you market it widely. No means that you are very, very selective. Getting some very interesting answers through on the chat. Okay, Paul, do you reckon that's enough time?
I think so, Andrew. Yeah.
Great. Okay, so yes, you should market it widely is the most common answer, but it's pretty split. So let's see what you've got to say, Paul. Looking forward to it.
Excellent. Thank you. Thank you very much, Andrew. And I've been looking in the chat. Wow, what a kind of diverse group of people from all over the world, as far as New Zealand. So thank you so much for entrusting your valuable time in us for this hour. So what I want to do, I mean, Andrew's given a sort of fascinating perspective of some of the challenges around real estate. And what I want to do now is talk a little bit about what impact do some of these drivers have when it comes to strategic influence and negotiation. And I think one of the key things that was interesting to hear from Andrew is a kind of differentiation between different types of real estate. So you've got your mass market real estate, your, let's call them commodities. They could be multiple flats, they tend to be standardized, they tend to be interchangeable. And because they're not unique, you need to have some broad influencing and negotiating strategies to appeal to as many potential buyers as possible. And then, of course, you have your unique assets. And thank you, Andrew, for sharing a photo of your house for this. But no, I'm only joking. But so these are unique. These are private luxury homes. It could be commercial real estate, which is very much in demand. And they have very specific characteristics. So they appeal to a wider audience. And of course, they have different targeted influence and negotiation tactics as a result. And due to the sort of liquid nature of both types of assets, and as Andrew said, the lack of a formal market clearing mechanism for property, influence and negotiation is even more important. I mean, you have to work really hard in regard to that. So it's not like the stock market, for example. If Apple shares are trading at $150, an investor can buy or sell instantly. But if you've got a home and you list it for $500,000, there could be weeks or months to find a buyer, negotiate a price, and complete a transaction. And this applies not just in real estate. I appreciate not everybody on this call is buying, or well, many of you have bought houses at some stage, or selling houses, but it applies very much in the financial sector as well, and the liquidity of the products you're selling, whether it be highly liquid standardized instruments to really complex illiquid assets. So it applies across the board. So in order to frame this part of the session, why is strategic influence so important? Well, as I mentioned, and as Andrew mentioned, we're dealing with highly illiquid assets. So strategic influence is really important to unlock value and mitigate risk. There's this differentiation between the types of assets. There's a lack of formal market clearing mechanism. And then, of course, if that wasn't enough, you're dealing with all those external shocks, from interest rates to hikes to pandemics. And you need influence and negotiation to help navigate uncertainty. Why is strategic? So what about, let's look at strategic influence. Why is it so important? And what actually is it? And I would say that strategic influence is the deliberate and long-term, I think long-term is important here, use of persuasion, credibility, power, and negotiation to shape perceptions, behaviors, and decisions in a way that aligns with what your ultimate goals and objectives are. So let's break this down. So in my opinion, there are three forms of social influence, essentially getting someone to do what you want them to do. In this case, of course, buy an asset, whether it be real estate or finance. Now, there's power and coercion. And power and coercion, sure, that sometimes helps if you have limited supply, if you're in the finance sector, you're a large bank or an investment firm, you can maybe set lending standards, set credit pricing. But I would argue that often power and coercion it tends to meet an obstacle as we go along, as Zhang is going to show with this video. John, are you okay to show the video? Oh, brilliant. Thank you very much.
Again, this is the USS Montana requesting that you immediately divert your course 15 degrees to the north to avoid a collision. Over.
Please divert your course 15 degrees to the south to avoid collision.
This is Captain Hancock. You will divert your course. Over.
Negative, Captain. I'm not moving anything. Change your course. Over.
Sir, this is the USS Montana, the second largest vessel in the North Atlantic Fleet. You will change course 15 degrees north, or I will be forced to take measures to ensure the safety of this ship. Over.
This is a lighthouse, mate. It's your call.
Thank you very much. I love that video, but I think it really demonstrates that power and coercion can only get you so far in all your industries. What else do we have? And then, of course, we have persuasion, where you voluntarily get someone to come around to your point of view. And the third one is my bag. I run the Oxford Program of Negotiation, is negotiation, essentially in back and forth communication designed to reach an agreement where you and the other side have some interests that are shared and others that are opposed. And I would argue that persuasion and negotiation are the most important parts of strategic influence. So in terms of strategic influence, it's so important because it shapes market perceptions. It can create momentum for those all-important transactions. It can position assets favorably in the market. And ultimately, if you use it well and you use all the negotiation tactics and influence tactics that a few of them I'm going to talk about today, it will lead ultimately to more successful outcomes. So what I want to do in this just remaining 15 minutes is just give you a few tools of social influence and negotiation. So the challenge, we spend a week in Oxford discussing this, is to synthesize it into 20 minutes. So, and another thing I'd say about these tools is that many of you are already using them. You're using them the whole time, but often without realizing it. So what I'd encourage you to do is to think of these tools and actually try and use them more strategically. And I'm going to unashamedly borrow from other experts in this field in regard to this, particularly a gentleman called Robert Cialdini, behavioral psychologist. Many of you will have heard of him. He wrote a book called The Psychology of Persuasion, and he's incredible. He's probably the most influential person in the area of strategic influence. So the first tool I want to talk about is what we call scarcity. Anyone like to tell me in the chat or take their mic off what scarcity means? We see it the whole time. Every time someone marketeers use it the whole time. Essentially, I'm running quickly here, we see things, very good, Leanne, brilliant. We see things as more valuable when they are less available. Every time you go into bookit.com or Expedia, or you see things like 3 people are currently looking at this hotel room, 5 people have booked this deal today, and it generates that sense of urgency, doesn't it? So scarcity is really powerful when it comes to persuasion. So let's look at it in terms of the two differentiation of assets. So since flats are interchangeable commodities, their value is essentially dictated by supply, demand, and perception. So if you're a developer, you're selling a 200-unit apartment complex in a very competitive market, and the flats are nearly identical, the buyers have many alternatives, then you want to leverage this scarcity, don't they? So ways you could do that. Only 2 units left at this price. You need to tell the truth, but you can frame things. Exclusive pre-sale discount in 48 hours. So this shares this idea of scarcity. Now, when it comes to the other side of the coin, the more luxury, the more high value products, penthouse, for example, panoramic city views, you want to create this idea that this is a exclusive offer, make them naturally scarce. So investors we're only considering people with 20 million plus in assets. I'm sure the majority of this call have that number of assets, but investors only considered with 20 million plus. Only once every 10 years does a penthouse like this become available. It's all about the framing, which is such an important element of strategic influence. And of course, we see this in the finance sector, don't we, the whole time? This IPO is 10 times oversubscribed. Only select investors will receive an allocation by invitation only. It's this idea of feeling that feeling of exclusivity, the scarcity principle in action. Let's try another one. Social proof. Again, feel free to put in the chat what you think social proof means, but essentially, that is all about we look to other people for guidance to determine what we should do. And this again happens the whole time. If you watch a comedy on TV, it could be Friends or Seinfeld or Curb Your Enthusiasm, one of my favorite shows, you have the canned laughter there, don't you? And it doesn't make things any funnier, but it tells you when you're supposed to laugh. And we see it the whole time in marketing. Fastest growing company, best-selling book. It shows that other people are reading this book, so you should as well. So how does that work in real estate? Well, again, it's very different based on whether we're talking about commodities, multiple flats, for example, or unique assets, commercial real estate, bigger houses, private companies, where the perceived value is influenced by how many people are interested and who those people are. So with flats, you need confirmation from the crowd, don't you? So 90% of units also already sold in phase 1. Another business has already put an offer in for this unit. For example, if you're a commercial, you're trying to attract top corporate tenants. Apple is already our anchor tenant. So again, you're using social proof. And then for the more luxury, the higher value items, the goal is not so much mass appeal, but exclusive validation from the right people. Say you're selling a unique penthouse with beautiful Central Park views. The agent could hint that the penthouse was previously owned by a tech billionaire, or buyers are told another high-profile investor is making an offer. So it makes your property seem even more desirable. And again, in the wider finance sector, again, we see it the whole time. 50% of Fortune 500 CEOs bank with us. Our hedge fund has been ranked a top performer for 5 consecutive years. Over 10 million people trust their savings with African Bank, a client of ours at the business school. So it's self-explanatory, and we don't always use it as strategically as we could, and we need to customize it based on different audiences. Now, my final principle, before I extend into another slightly different area and touch on negotiation, is liking. Again, this is one of Cialdini's principles, and it's all pretty self-explanatory. We like to do business with people that we relate to, we feel a personal connection with, people essentially we like and trust. It makes obvious sense, doesn't it? But in real estate, the way this principle applied, again, depends on what you're selling. So for flats, liking is about making people feel emotionally connected to the property. Since flats are interchangeable, that friendly, relatable sales process increases trust. So relatable marketing, community engagement, a personalized buying experience. But for commercial real estate, it's not about mass relatability, is it? It's about that personal trust and exclusivity. Buyers don't want to feel like they're being sold to in a traditional sense. They want to feel personally invited to an exclusive circle. So again, it's about high trust relationships, and it's about personal introductions. And this kind of links in to, I think, really one of the cornerstones of persuasion and influence It's all about trust. Trust is the cornerstone of negotiations and any persuasion, social influence interaction. But how do you build trust? Sure, there are things sometimes you can do to quickly establish trust, find things you have in common, walk the walk as well as talking the talk. But this is just one tool which you might want to think about when it comes to building trust. And this is by Stephen Covey. Many people would have come across Stephen Covey, the very famous book, 7 Habits of Highly Effective People. Franklin Covey is his consultancy. But I find this quite a useful model. And Covey would argue that it's within your gift to develop trust. It doesn't have to be that long term. And what Covey talks about is, he says trust is based on basically 2 dimensions: your character and your competence. So for your character, for example, it's about your intent, your caring, your transparency, your openness. What's driving you? How much do you care? And then, of course, there's your integrity, your honesty, your authenticity, your fairness, your concern for others, your ability to keep your promises. So that's the character side. And on the other side, we have competence. That's all about your capabilities, your skills, your knowledge, your experience. And then the final one is results, your track record of delivery, your credibility and performance. And it's about these 4 areas working in tandem: intent, integrity, capabilities, and results. The more you focus on these areas and the more you better articulate these, the more you can develop trust quickly and effectively with the people you're trying to persuade. But again, this Covey model changes slightly based on what you're trying to sell. Again, we're looking at the commodities versus unique assets dynamic. So for commodities, for example, for mass flats, buyers don't need that personal trust in the seller. They need to really focus on the seller's reputation, that it's a decent investment, that the contract, the price is fair, that the deposit is secure. It's about competence. So in this case, it's about establishing the credibility of the seller. It's about ensuring transparency in the transaction, completion guarantees, price protection, a recognizable bank as a finance partner. But for unique assets, it's more about the character. Buyers need a deep personal trust in the seller and the negotiation process. These are high value, one-of-a-kind assets, like commercial properties, private businesses, where trust must be built personally and strategically. So it's about exclusive relationship-driven selling. It's about building those long-term relationships based on trust. The seller who has a history of fair, discreet transactions will command better deals. And of course, it's the same in finance as well, from the wider finance sector, from mass market financial services, which focus on competence, to those more exclusive high net worth individuals, institutional investors, corporate finance deals where competence alone just isn't enough. Trust must be personal, strategic, and built over time. So that is a few of Cialdini principles, a focus on trust. And what I want to finish is talking a little bit about how that links into negotiation. And of course, as I said, I run the Oxford Program of Negotiation. We have many people in real estate and finance who've been on the program over the years. And again, there's a slightly different approach to negotiation based again on this differentiation between commodities and unique assets. So with commodities, for example, you have many alternatives, don't you, as a buyer? So it makes that negotiation more competitive, more price sensitive, and it tends to be more standardized as well, since the buyer has got lots of alternatives. So again, here, negotiation is about speed, it's about pricing, it's about a sense of urgency, and it's, to be honest, more focused on claiming value. And it's where tactics such as time pressure, scarcity, and anchoring, which I'll talk about in a minute, are really, really powerful. And the second one is unique assets. So buyers have few, in this case, buyers don't have so many alternatives, do they? They actually feel even privileged sometimes to even be negotiating. If you can really work on that scarcity principle, you're very lucky to be able to be in this position to negotiate. So this makes negotiation more relationship driven, more discretionary, more premium focused, and it's more about creating value as a result. So this distinction often affects power dynamics, it affects leverage, it affects pricing strategy, and of course there's other psychological tactics around negotiation as well. So I want to leave you with one negotiation tactics. And to do this, just to make sure you're all awake, and just to keep the grey matter working really hard. Just a very, very simple mathematic question here. I don't know if anyone wants to take this one out. On 1 times 2 times 3 times 4 times 5 times 6 times 7 times 8. Can we quickly get the answer, please, in the chat? Carlos, you know this one? Anyone else? Leanne, do you want to give it a go? Shaker, Charles? I'm not quite sure what that is. Oh, Michael, that's very good. Did you promise you didn't use a calculator there? It is exact. It is absolutely. It's 40,320. You're completely correct. Very good. Nobody gets that, Michael. That's very impressive. And Charles, you got exactly the 8 factorial. But yes, you're quite right. The answer is 40,320. But the way the question is posed, so the second question is 8 times 7 times 6 times 4 times 3 times 2 times 1. And actually, the answer to those is exactly the same. But when you ask people, these are the average answers. So the first one, the average answer is 512. And the second one, the average answer is 2,250. So my question for you is, apart from the fact that it shows that we're not very good at maths, why is there such a big difference to essentially the same question? Why is it so much higher with the second one? I'm going to answer it if I get, oh, there, very good, Ryan, very good. Of course, it starts with, so the first one starts with 1, and the second one starts with 8. So this is the power of anchoring. I'm sure many of you have come across it before, but I cannot do a real estate session without talking about anchoring, because it's so powerful. It's a psychological principle where the first piece of information acts as a reference point, shaping how people perceive value. And there's some very famous piece of research which shows that when given a high listing price, agents provided higher estimates for the home's value. So if an agent goes in there and you've already put a high listing price, they will say that it doesn't drive them at all. They're experienced, they'll value the house on its merits, but that's not the case. They're driven up. And when you provide a low listing price, agents will adjust downwards as a result, even though, again, they claim their decision is based on objective factors. So what this means is people adjust rather than create when making decisions. So anchoring is incredibly powerful. It's incredibly powerful in terms of making the first offer, as long as you've done your homework. The power of the first contract. If you put a contract out there, you're basically anchoring the discussion. They're very unlikely, they might well put some red lines through it, but they're very unlikely to rip it up. And it's the power of setting the agenda as well. Agendas can be really powerful in influence and negotiation, because you kind of set the terms. What are the issues you want to discuss in what sequence? So it can be a really important strategic element of a negotiation. So when it comes to real estate, again, anchoring is used differently for commodities and unique assets. So with flats, it's about setting price expectations, making discounts feel significant, and encouraging buyers to act quickly by making price seem like a limited opportunity. Whereas in commercial real estate, private companies, high-end homes, pricing is more flexible and subjective, and so it can be used to justify premium pricing by framing the asset as unique, shifting buyer expectations upward to maintain negotiation power, and creating a high reference point so even a discount remains profitable. So think about that idea of anchoring, putting that number on the table. And when you're the recipient of anchoring, the best thing to do is to ignore their anchor. So don't argue about it. Don't say, how can you possibly ask for $600,000 for this flat? Because the more you mention it, the more you psychologically embed it in the negotiation. So it's a very, very important thing to think about. And the final thing I'd say when it comes to negotiation, when it comes to strategic influence, is the fact that so much of the information we provide is essentially based on a reference. References really matter in a negotiation. So the number you put down causes people focus around that reference. So let me finish with an example from a very famous, many people will be aware of this, hopefully you can hear the sound, where references really matter.
Beautiful. Can it be a real Chanel? Oh, it is. $90. But it's marked down from 2,800.
There you go, from The Simpsons. So thank you very much. Lovely to spend some time with you. I'm going to open it up to kind of questions now, either for me or Andrew, and then we'll sort of finish off by our team from Oxford telling a bit about our program. So any questions, feel free to take your mic off. I don't know if I haven't had a chance to look at the Q&A. But yeah, happy to take questions. There's a couple there already, Andrew. I'm gonna give them to you. I've spoken too much.
Absolutely fine, Paul. That was great. Thank you very much. Really good. Yeah, we've got three or four questions. We've got a lot of good chats, and the questions that have come in, I've answered one of them from Charles, but Charles's point was that there's probably a difference between investors in residential real estate and owner occupiers, and I think that's a good point that you will have a view on, Paul. I think the owner occupier is more likely to be affected by the flattery of being invited to negotiate than the investor, and that's down to the psychic income that people get from residential real estate, from living in a place. So I think a lot of these I think it's a really good point that distinguishing between the nature of the buyer, a professional investor from an owner occupier is pretty relevant. Having said that, all of the things that you were talking about, Paul, are relevant to the commercial property investment market, where that is an investment market, and we do know that this idea about anchoring, that absolutely works in the commercial market, and so does the idea about not exposing the property too widely to the market. This idea about off-market sales. I've been looking at a couple of cases recently where two properties that I've written cases about have been put on the market, one in 2018 and one in 2020, and they're both 5 years ago. So there's been no change at all, and that's a great example. I suspect one of them might sell for about 50% of the asking price, but there's no way on earth that the sellers are going to advertise the fact that the price has fallen, because that would set in train this suspicion. I've got a great point also from an anonymous attendee saying that, what about Islamic finance? If interest rates are such a problem, why not go to a different form of finance? I think that's a really good point. I think the UK has a particularly punitive mortgage system where you can't fix your mortgage interest for very long. So at some point you're going to get caught on the refi. Not true in the US, not true in Denmark, and Islamic countries. I suspect, well, I'm not an expert on Islamic finance, but I suspect there are better ways of doing it. And David Higgins is saying that most residential buyers come from the local market, 3-mile radius. Well, that might well be true. I suspect that's more true of the commodity property than the special property, which we showed a picture of. I think the more unique the property, the further people are likely to travel to buy. But it does of course influence the marketing strategy. Violetta, from a seller perspective, what strategies do you recommend for effectively engaging with an agency or an intermediary? That's a really great question. At one point, I thought it was best not to use them at all. Why not simply put your property on Rightmove or a website and deal with it yourself? And I've found from bitter experience that actually the agents had a lot of value. There are a lot of things they do apart from negotiate price, like dealing with lawyers and also dealing with customers, working out who the serious buyers are, who the serious buyers are not. And I think there's a lot of things for working with an agency. But the key question is, what is the selling strategy going to be? Is it going to be wide advertising? Is it going to be selective invitations? Is it going to be sealed bid? So I think there's a lot of issues to be talked about there, and having an honest conversation with the broker about what's worked in the past. Also, bearing in mind that the estate agent has very little motivation in maximizing the price. That's the key point. Great book called Freakonomics pointed this out, that the motivation of a broker who charges a commission is to sell the property quickly, not to sell the property for the highest price. It's much better to sell 3 houses in a month than one in a month, which you get 10% more for. So it's understanding the motivation of the broker is important too.
Yeah, should I add to
Yeah, that's
that?
enough of me rattling on.
Yeah. So yeah, in terms of I mean, in negotiations, often you have an intermediary. You look at the big international negotiations which take place. We had a big negotiation in Northern Ireland in the late 90s where the US was a very important intermediary. What I would say about they can be helpful, they can be an obstacle. It's important to select the right intermediary. Make sure in terms of your negotiation, your strategy, that they're very clear about what your objectives are, what your expectations are, and make sure you build a strong relationship. See them almost as an extension of your sales team as well. I think that's really important. Shall I take another question, Andrew, and I'll hand back to you. So this was a question on, it was kind of more linked to negotiation. I'm from a large college. So this was Pat. So you're trying to purchase a building from an international organization. In terms of kind of your negotiation approach to this, I mean, I think it's important to really kind of try and get this international organization to see you as a true partner. So try and structure the negotiation around shared value rather than just price. So the more you can align it with shared interests, with more long-term benefits, the more likely you are to create value in the negotiation. Quite often, the main negotiations which tend to fail is where you've got one issue, one binary issue, price, often. So you go back and forth, you gain, they lose. So the more you can add in different issues where you might have different priorities on those issues, the more you can actually start to create value in the work and try and justify as much as you can as well. But yeah, Pat, great question.
Yeah, we've got a couple of other interesting ones. Is technology changing the way in which we negotiate? And I have to say it's not very much is my experience, but it will. It's a very, very slow moving market in real estate, and it's not really in anybody's interest to speed up property transactions. That's another thing that I think is a bit of a myth. You know, we don't really want to buy a house in 2 days because we need plenty of time to reflect about it and think about it. So technology is, of course, theoretically available to speed up transactions, but actually, when you think about human motivation, it's not always in their interest to do that.
Absolutely. At Walmart, actually, so in certain areas like supplier negotiations, AI is actually becoming quite predominant. So I think Walmart negotiates, I think, up to 60% of its suppliers. If you're a supplier of Walmart, you'll be negotiating with an AI bot rather than human, so which is slightly terrifying. But predominantly, negotiation still tends to be between people.
Yeah.
Quite so fascinating, and that's why the psychological aspects come to the front. So I'll take one more from Leanne, and then happy to.
Tino's made a good point, Paul. Just Tino's made a point that in the age of sites like Zillow, surely everybody knows the history of the property price, which is true. Which is very true, and that has changed the way people think about things. It's another form of anchoring, of course, you know, because it gives people an idea that the house will be probably worth more than the number that you can see on Zillow. There are plenty of cases, though, where houses have just not transacted before these sites were up. So the house I've been talking about has been in the same ownership for 30 years, and there's no price information at all going back. Sorry, Paul.
Oh, sorry. So no, just looking at Leanne's question, is there please a reference value work on liking? So liking is just obviously one element of persuasion and negotiation. And if you're looking for something more strategic, more detailed, obviously complex negotiations, it sounds like you're involved with, Leanne, combine the alignment of interest, looking at value creation, looking at strategic empathy, looking at relationship building, different styles. I think you need to come on the Oxford Program negotiation for a week to get the details on that. But yes, it's just one element of a very kind of broad area, broad discipline. How are we doing with time, Andrew? Do we need to? I'm happy to sort of answer questions outside the call. Just kind of, I think there was one on the chat, wasn't there, from Matthias? He's a friend of mine, actually. What are your recommendations for the very first contact with a potential client? How will you maximize the chances for an anchoring in your interests? Well, from my perspective, I have to hand over to Andrew. I think it's all about finding out about them. So the more you can find out what their interests are, what's driving them, the more you can focus on building the relationship. So you don't always need to go straight into the commercial, the interaction, the transactional side. And the more information you have on where they're coming from, what their challenges are, who their stakeholders are, the better position you are to go in and anchor and maximize your chances.
Yeah, there's been a lot of chatter recently since prop tech got very interesting. There's been a lot of interest about writing more stories about houses. So the things that people would really start to engage with is if they knew that somebody interesting had lived in the house historically, or if there was a great party every year in the house, or just a bit of color that gets away from the idea of the property as a commodity and towards the property as something special. And there are a few sites now which tell stories about real estate which make people slightly more likely to engage. It's not something you can easily expand though, because there are very few properties that are seen as special. Another ex-student of mine is trying to work on a site where you can value your house every day. And I've told him there's no reason that everybody would want to know what the value of the house is on a daily basis because the market's too slow. But interesting.
Thanks, Andrew. I appreciate we haven't got much time left. So very happy, Paul Fisher, Oxford, LinkedIn, if you have any follow-up questions. I'm just going to hand back to our team at Oxford to kind of finish this session, tell you a bit about our program. So I don't know who's going first. Is it Clara or Christine? Over to you.
Hi everyone, I hope you can hear me and see me. Thank you so much, Andrew and Paul. This has been a really fascinating webinar, and I don't think we've got so many questions and not enough time. So if you do have further questions, please do email them to us and we'll try to answer them for you. This webinar has been in support of the Oxford Real Estate Programme and the Oxford Programme in Negotiation. Our next real estate programme is taking place from the 30th of June to the 4th of July. So that's your opportunity to join us here in Oxford, meet Andrew in person and ask some more questions. If you'd like to find out more, please do scan the QR code or reach out. I've dropped in my LinkedIn, and if you'd like to have a consultation call with me also, please do reach out. I'm going to hand over to Christine to talk a little bit more about the Oxford Programme of Negotiation. See you soon.
Hello, and thank you everyone for joining us on this webinar. I hope you learned a lot from this hour that we shared together. I know it's so many questions, not enough time to answer, but to those who would like to delve deeper into these topics, we are running these two amazing programs this year. Clara's spoken about the real estate program, and we also have our program on negotiation. So this program happens every year. It's been happening for 20 years now. So this is a program that we're really proud of. It's happening for 5 days, and it's highly immersive. The dates are the 9th to the 13th of June. And it's a program that takes you through the tried and tested frameworks and tools on negotiation. And it takes you through a journey from learning simple negotiations between two people, simple topics, and we add complexities every single day. So by the end of the program, you would be very familiar and confident in negotiating complex topics with multiple parties and stakeholders. So it's a very fun program. It'll take you out of your comfort zone. And if you want to learn more from Paul and our other program director, Owen Derbyshire, please feel free to reach out. I have dropped the link on the chat, and also you can scan this QR code. And please do connect with us on LinkedIn. I dropped the link for Paul's LinkedIn on the chat as well, and my own.
Great, thank you very much. We actually have I mentioned in the chat, we actually have a real estate simulation in the negotiation program. So the first morning, actually, you're negotiating to sell some commercial land in a fictional town on the East Coast of the United States. It's a great warm-up session, which tells you a lot about questioning, realizing, understanding the zone of possible agreement with your counterpart, and it's really good fun. I think that's all really, unless anyone, I think a couple of people asked for book recommendations. I know Andrew's put some in the chat. I've got a whole list of further reading we give to our students, so very happy to do that. If anyone would like to email me, I'll just put my email in the chat. But yeah, great to see you all. And unless anyone has any further questions, I wish you all the best with your selling, your negotiating, your real estate, your finance, and it's been good fun. It's been good fun working with you, Andrew. First time, hopefully first time.
Same here, Paul. Same here,
Hopefully
Paul.
not.
Not the last time, I hope. Great.
Thanks very much, everybody.
Thank you.